I'm sure a lot of investors are concerned about the geopolitical tensions in the Ukraine when Russian forces have actually invaded that country. Today, I'll be talking about how building a dividends-centered portfolio would be able to actually insure yourself from the political risk or the chances of things actually escalating from the conflict. My name is Christopher Ng Wai Chung, and let's get into my presentation for today. All right, the situation in the Ukraine, it's actually not particularly good. As I'm not a political analyst, here's what I think it's likely to happen and unfold in the Ukraine moving forward. All right. So the first point I want to make is that Russia's wish for a very quick conquest right now is being frustrated by Ukrainian defense forces in spite of these overwhelming numbers. So that is likely to delay Vladimir Putin's ambitions for a very quick resolution of the situation and the war. The second point I want to make is that no one actually prefers a prolonged conflict. It would be disastrous for Ukraine, but the Russians will also suffer as well as economic sanctions begin to bite them. And finally, at the time when the slides are being made, the latest update is that there seems to be some willingness of the Ukrainian leadership to meet some of Russia's demands, right? So we're actually seeing both sides actually getting into more diplomacy as they begin to weigh the effects of the invasion, all right? Which means the conflict is going to be constrained by the amount of time that Russia has, all right? Because if they were to prolong this, economic sanctions are going to bite them. But we really wouldn't know how long elevated commodity prices will last, which is what investors are concerned about. If the price of oil as well as various commodities would spike to a high, this will have a very negative effect on the kind of portfolios that we build. All right, and with that as the big question mark, we'll be actually looking at any good news that involves a de-escalation from the conflict. All right, so that's what I have to share regarding the situation in the Ukraine. All right, let's look at the early retirement masterclass portfolio, which is the dividends portfolio that's been built by 24 batches of 600 students spread over 70 plus stocks. Each batch builds a portfolio of 15 to 20 stocks that comes from a mix of local Singapore equities, real estate investment trusts, and business trust counters, right? Important feature is that it currently produces a dividend yield of 5.5%, which means that if you have invested, for example, $100,000 in this portfolio, it will generate $5,500 every year, right? With major paydays happening every quarter in the months of March, June, September, and December, right? And how has this portfolio has fared? If you have built a diversified dividends portfolio like what my students have done, we've actually gone through a period of serious underperformance against the Straits Times Index. And why is that so? The reason is because the Straits Times Index is largely concentrated in local banks. And with everybody thinking that there's going to be an economic recovery with rising interest rates, local banks, 40% of the SCI, has basically advanced ahead of the rest of the index. And so they've shot up relative to the rest of the markets. Because we wanted to diversify our dividend portfolio, we don't exclusively own banks. We also have real estate investment trusts as well as some business trusts. So the performance of the portfolio has been slightly lagging against the benchmark for about 6 to 7% at the beginning of the year, right? But it's still making money. However, thanks to the invasion of Ukraine, the banks have actually retreated as investors now believe that interest rates may not rise as quickly as what we've thought in the beginning of the year. And so we've had this situation where the portfolio is losing a little bit of money, but the gap between the portfolio and the benchmark have narrowed. So we're now lagging at about 3 to 4% behind the STI. Overall, year to date, we're down about 3.31%, which, if you think about it, these are excellent results compared to the people that's invested in markets like Hong Kong and in the markets like US. All right, so the ERM portfolio, any dividend portfolio focused in Singapore, has very defensive qualities that can be used to prevent your portfolio from getting worse as the situation unfolds. Now, why are dividends a good idea now? Right? I think the first idea is that if you're used to a portfolio paying 5% dividends at the end of 2021, the fact is that the yields have now gone up to about 5.5%. So dividend stocks are actually much cheaper than before. Right? Now, there is quantitative evidence to show that dividends-based counters tend to experience a smaller slump when the market enters a crash regime, which is something that a lot of people do not like, right? Like the situation happening in places like Hong Kong right now, where the market is going through a crash. It's down from its peak by more than 30% now, right? And dividend-based counters have a tendency to drop less, all right? So while there is a slump, the slump is much smaller than the rest of the markets. The second idea why dividends are useful is that dividend stocks continuously spin off money in the form of cash that will appear in your bank account. Now, you can, of course, take this money and you can spend it, but what we do on a crash is that we normally take this money and we reinvest it in other dividend counters or even some really badly beaten up growth counter when it's beaten down, and there is a bargain hunting kind of phenomenon going in the stock markets right now. And I think the best time to buy is when there is a lot of blood on the streets, right? And I think that's literally happening in some parts of the world right now. The final reason is that dividend counters have a tendency to be mean reverting, so it supports trading strategies that buy low and sell high. There is a tendency for dividend stock prices to behave like a coiled spring. So if you were to compress this spring and you let it go, it would quickly bounce back. So actually, the lower it gets, the higher the probability of a serious rebound, right? So with this idea in mind, a savvy investor could actually set aside some funds slowly to accumulate dividend stocks, right? But keep this on a reasonable pace and pace it regularly with your monthly salary, very much like dollar cost averaging, because the truth of the matter is that nobody really knows how long this crisis in Ukraine will last. And if the economic sanctions bite harder, the price of oil is going to be spiked, and a lot of families around the world will be spending a lot more of their disposable income on fuel, electricity, and the bare basics, and there's not enough money to get other stuff, right, like luxury goods, and that would have a very, very downwards kind of effect on the general economy. So in summary, the situation in the Ukraine is fluid, all right. Some analysts believe that a prolonged conflict will not just be catastrophic for Ukraine, but also be extremely bad for Russia. Local dividend stocks remain a safe and attractive place to park your money while world events unfold. We've shown that our losses, while they're still there, they are very, very tiny losses compared to what other investors are experiencing right now. You should allocate your funds in the direction and pace it along with your paycheck and investment earnings so that we'll be able to take advantage of the recovery when it happens later on. All right, so take your time, set aside some funds, and position yourself in place when the market recovery will inevitably occur when both parties begin to sit together for peace talks. That's all I have for you today. Thank you very much.